Hello and welcome to Money, 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 your weekly personal finance date with me, SURABHI UPADHYAY. We all want to build a good equity portfolio to optimize returns and create wealth. But how does one go about selecting from the plethora of options in the different funds which are out there? This week on Money, 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 personal finance expert HEMANT RUSTAGI joins me to chalk out the right MF portfolio for different life stages and different age profiles. Thanks so much, sir, for joining us on the show today. It's great to have you on. So, here's the question. Almost everybody now is more or less convinced that the equity market is a route to create wealth. But the question is, how do you get onto the journey? What bus do you catch? At what point do you need to churn your portfolio? And where you really begin?
I think first and foremost, I think every investor needs to realize what is the role equity has in the portfolio. If you talk about a particular asset class here, everyone knows that equity has the potential to build huge corpus for you. You get the best return, but not many people have the patience to go through whatever volatility comes on the way. But the problem is, if you decide that you want to invest for a long term, what are the long term goals? Depending on at what stage of life you are, it could be to build a corpus for your child education, for marriage, or even for your retirement funding. The thing is that these are all long term goals. What they require is that you need to invest in an asset class like equity, which has the potential to give you higher return, but there has to be some amount of discipline. The problem many investors have is whenever they're faced with volatility, they don't know what to do.
That's one problem. The other problem perhaps also is not knowing when you actually need to churn your portfolio, when you actually need to weed out funds that are perhaps not working or they're not in tune with your own goals. So let's start by breaking this down in life stages, because I guess a lot of the type of funds that you select will go as per your age profile, your risk appetite, your risk profile, etc. So if we start with someone who is a new earner, someone in their mid-20s to maybe early 30s, where does that person begin?
Well, I think we always talk about start investing early. Why do we say that? You're at a stage of your life, you're not earning serious money. You're a new investor, you're a beginner. You can afford to make mistake. Now, what it does for you is when you become a serious investor later on, you're not scared of equity. So what do you do when you look at, let's say, start building a corpus? Now, this is not the age where many people think about retirement planning. But the fact is that if you start putting aside some money, even if it is a few thousand rupees.
So do you have a thumb rule in mind? If you're looking at an annual income of, let's say, X, what percentage or proportion should perhaps go into an equity investment in this age bracket of 25 to 35?
Well, I would say, maybe around 15-20% at least to begin with.
Okay.
I think the fact is, like, if you start investing 15-20% of your money, it can help you build a corpus. And of course, important thing that you need to remember is that as you go along, you need to keep increasing that amount. It should not be that you begin with few thousand and you continue with that. Sure. Important thing is, equity as an asset class is aggressive. Again, another mistake that investors make is they make their portfolio very aggressive. Why do they do that? Because, they look around, which are the funds in a bull market which are doing well. There are small cap funds, there are mid cap funds, there are sector funds, there are thematic funds. So they feel that since I'm coming into equity, why not go for the best? Best is not what you look at in terms of
the
return,
short-term return. The short-term return.
Exactly. You need to look at what is the product that suits you. Don't forget, equity as an asset class is risky. You don't have to necessarily make your portfolio more risky by going into these aggressive funds. The second thing which you mentioned about how do you know when to exit. See, if you are investing, let's say at this early stage of your life, there are going to be periods even the best of funds will not perform well. You don't have to panic. See, how do you measure whether your fund is doing very well or not? Right. Don't go by absolute return. The problem is when you look at absolute return, we say, okay, it's minus 5%, it hasn't done well. You need to look at relative performance. Every fund has a benchmark. And I think more important is the peer group. So if you're invested in a multi-cap fund which has a bias toward large cap, look at how the rest of the funds have done. Okay, if the markets, the benchmark has gone down by 10%, your fund has gone down by 5%, the fund manager has actually delivered returns.
So fair enough. The first thumb rule, 15 to 20% of your monthly income, let's say, should go towards a form of investing if you're 25 to 35. Here's the other question. How much of that should go towards equity? Should you allocate the 100% of that capital towards equity funds? Should you look at balanced funds? Should you also look at an element of, let's say, standalone debt funds? Again, we're talking about a portfolio for someone who's 25 to 35 years old.
Well, I think it clearly depends on your different goals. Okay, now you look at maybe your current income. okay, saying that, okay, if I maintain the same standard of living, how much would I need? As I mentioned earlier, you need to keep increasing that over a period of time.
Sure.
Then you need to work back and see how much money you need to invest. Maybe you require to invest, let's say, 15,000 per month, and you don't have that much money. So what do? Don't wait for 15,000 to be there for you to start investing. Even if you can spare 5,000, 10,000, start investing. In the meantime, if there are other goals which are short-term and medium-term, could be, for example, you need to create an emergency reserve. All of us must have that. So some money has to go there. What do you do there? There you can look at funds like liquid funds, ultra short-term funds. You cannot be investing money that is required after 6 months or 1 year into equity. At the same time, if you're investing for the long term and you end up investing in these funds, you'll underperform. So you need to look at what is your time horizon, goals, and if you don't have enough money to take care of all the goals, that's the time for you to prioritize your goals. Which are the goals which are more important? But I always believe that you must keep an eye on the long-term goals like retirement planning.
Fair enough. So some examples then that perhaps viewers can take away from some sort of funds that you prefer or would like for this category, where people can take on slightly more, an aggressive stance in their equity portfolio.
Well, like I mentioned earlier, I believe that equity is an aggressive asset class. If you're a beginner, make sure they're investing in well-diversified fund. So some of the fund which can be a part of the core portfolio are like you have ICICI Discovery Fund, HDFC Equity Fund, Reliance Equity Opportunity Fund.
And all of these funds have a bias towards large cap?
Some of them will have, if you do a mix of it, you will essentially get a portfolio which is investing, let's say, 60-65% in large cap and the rest in debt. Then you have Kotak Select Focus Fund. So these are 4 or 5 funds where you can begin investing. Okay,
so we'll take a break on that note. We've just gotten started. We'll come back and discuss the next life stage. When you're from 35 to around, let's say, 45, how does your mutual fund portfolio need to change? What should it be geared up for? That and more after the break.